Japan just raised interest rates to their highest level in 31 years, and it did so going against the explicit wishes of its own prime minister, under pressure from Washington, with a currency in freefall and war-driven inflation on the horizon. Here's what happened. On Tuesday, the Bank of Japan announced it would raise its benchmark interest rate by 0.25 percentage point, bringing it to 1%. That's the highest the rate has been since 1995. The central bank cited rising crude oil prices and inflationary pressures tied to the war in the Middle East as the driving forces behind the decision. And officials made clear this likely won't be the last hike. They said they'll keep raising rates while monitoring prices and the broader economy. Now, to understand why this is a big deal, you have to understand the position Japan has been in. The country gets about 90% of its crude oil imports from the Middle East. When the Strait of Hormuz closed in February, that supply chain was essentially severed. Japanese businesses were already bracing to raise prices in the coming months because of shortages of naphtha, an oil byproduct used in things like industrial inks and plastic packaging. At the same time, the yen has been sliding hard against the dollar, recently falling past 160 yen per dollar for the first time in nearly 2 years. A weaker currency means imports, fuel, food, you name it, get more expensive. Japan's finance ministry has spent tens of billions of dollars trying to prop up the yen, with limited success. So the Bank of Japan is trying to get ahead of an inflation surge before it hits. And the playbook here is explicitly drawn from 2022, when Russia's invasion of Ukraine caused the last major disruption to global energy flows. Back then, the European Central Bank called inflation transitory and waited too long to act, and Eurozone inflation shot past 10%. This time, central banks aren't making that mistake. The ECB has already signaled tightening and follow-through with a rate increase. The U.S. Federal Reserve is heading into its first policy meeting under new Chairman Kevin Warsh as inflation climbs at its fastest pace in 3 years. Nahiko Baba, chief Japan economist at Barclays, put it plainly, central bankers learned from the experience of 2022. With price increases already showing up in the data this month, he said, they want to move before that happens. But here's where it gets politically complicated. Last October, Sanai Takaichi won election as Japan's prime minister, and she has been a vocal advocate for a weaker yen and low interest rates. A weak yen traditionally helps Japanese exporters by making their goods cheaper in global markets. And Takaichi's agenda, stimulus, tax cuts, higher defense spending, requires significant government outlays that get harder to sustain when borrowing costs rise. The Bank of Japan had last raised rates in December, then held steady. Takaichi, not unlike Donald Trump in the United States, had been pushing for rates to stay low. So what changed? Pressure from Washington, 4-1. U.S. Treasury Secretary Scott Bessent visited Tokyo in May and conveyed frustration about the yen's weakness. He argued the Bank of Japan should operate free from political pressure to keep rates down. And with the yen continuing to slide and war-related inflation bearing down, the calculus shifted. Baba from Barclays said the Prime Minister still has a deep, unshakable belief in the benefits of a weak yen, but faced with pressure from the US and sharp depreciation, he said, no matter how much she herself opposes a rate hike, she has no choice but to passively accept it. There is one note of potential relief, an agreement between the United States and Iran to reopen the Strait of Hormuz. Bank of Japan Deputy Governor Shinichi Uchida acknowledged at a news conference that the deal had reduced risks to the Japanese economy. But he was careful not to declare victory. We don't know what will happen next, he said. Economists still expect war-related pressures to show up in Japan's pricing data this month, with lingering supply chain strains and higher inflation likely to persist through the end of the year. Markets took the news in stride. After the decision was announced, Japan's benchmark Nikkei 225 index briefly surged above 70,000 for the first time ever, before pulling back and closing just slightly higher. Japan's central bank just made one of the boldest rate decisions in 3 decades, and the world will be watching to see whether it was bold enough.